throughout that 100-year period, there have been interest rates that have gone up, down, very high, even to nearly 20%, and prices still increased during that period, right? So that tells you that interest rates aren't necessarily the deciding factor. There's other market fundamental variables that are playing a role here.
Excited to bring Tarek Moussa to the call. Tarek is a former BlackRock employee. He's the current director of investor relations with Disrupt Equity. His focus is on capital raising for multifamily acquisitions throughout the company. Tarek, welcome. Excited to hear what your thoughts are on our question this week.
Yeah, hey guys, thanks for having me. Great to be back.
What's going on, Tarek?
Not too much. How are you guys?
Good. We've had some conversations about this offline, and I know you're out there, like you're moving pretty swiftly in the market right now, and you've got your hands on a lot of existing inventory, buying new inventory. So, what do you think? What does the real estate market look like for you from what you're seeing, boots on the ground, over let's say maybe the next 12 months, and then you can even expand it out over the next maybe 24, 36 months?
Oh, that's a tough one. I think on our side, we focus on multifamily, obviously, right? But I think it's no surprise that interest rates are moving a lot these days, and obviously going upward. But the question is ultimately, what is likely to come in the future? Not to put a prediction out there, but I guess it's our expectation that given the political environment and what's to come with the elections and so on, we think that, yes, things probably will increase, but it'll continue to increase at a decreasing rate, or it may actually come back down for a time. Is that going to be the case over the long term? Probably not as much, but I think there is a period where we may see some easing of the interest rates, which ultimately opens the market up a little more and makes it a little more affordable with better returns and so on out there.
So when you're saying increase, and then further defining that as increasing at a decreasing rate, are you referring to pricing and rent, or both, or what?
Actually, I was talking about more so on the interest rate side, so on the financing. Okay. So ultimately, what does that do? That just means that when interest rates obviously are higher, that means that our debt payments are higher, which means there's a lower return on our profitability, technically, right?
Yeah, 100%. So how are you thinking that's going to impact from a multifamily standpoint? How's that going to impact pricing, rent, and of course, going forward, what's buyers' appetite for that?
Yeah. Well, as interest rates increase, that means that people can pay less for the property, or for the, usually the property, frankly, from the ownership side of things.
So the return's going down, right?
What's that?
Because the return's going down, assuming
Exactly.
all else equal.
The returns go down, the amount of leverage you can get for the bank is going to be lower, and so on. So it's just multifaceted, but ultimately it just reduces the price point that you can actually offer on these deals. So ultimately, what does that mean for us? I think that you're going to find that more people out there, tenants, renters, if you will, who once upon a time would be looking to buy a home, it's going to be more challenging for them to also be able to afford their own property, which means they're likely going to be looking for a place to stay, which obviously bodes well for our business because ultimately we provide housing for folks.
Okay, so dissecting a couple of things there. On the single family homeowner side. So what you're saying there, and you're focused on multifamily, but because more of them may be priced out of the market because of higher cost to buy, there's going to be more renters. Now that's good for multifamily landlords, just anyone in that space. Now on the seller side for multifamily, how has it been? How have they adjusted in over the last few months with these rising rates? Are they more sticking to the notion that everything's going up and they're expecting that shoot to the moon price, or are they being a little bit more flexible now?
Yeah, I think at the beginning of the time that the interest rates started changing, they were all still aiming for the moon and hoping to get as much as they could out of this, but they've had to temper their expectations and be more realistic and understand that, hey, things aren't as they were. And what the challenge is, it's not a problem on our side, but it's more so a problem on their side, where ultimately, whenever you buy these deals, you want to be pretty conservative what you expect on the outcome, right? Don't want to be overly aggressive just because you don't know what's going to happen. And in this case, those who got overly aggressive and assumed that the rising rates, prices were going to continue indefinitely, they're now in for a big surprise. And thankfully, there's usually a broker intermediary between the buyer and the seller. So the broker have had to kind of set the seller's expectations and put them back to reality, show them that, hey, you're going to have to take a price cut and be more realistic. Otherwise, you can hold on to the deal indefinitely. But in most cases, a lot of these folks, at least the size of the deals that we play with, that we work in, they tend to have a timeline to when they need to exit the deal. So if they want to sell the deal, they have to put it at a price point that's going to be competitive, and that price point these days is lower than they may or may not have initially expected.
All right. So, and you would talked about growth, but more slowing of growth. I think when a lot of folks out there, they're saying, hey, prices are going to fall. They're not necessarily thinking of slowed growth. They're thinking of negative growth, i.e. 2008 to 2010. Is there any type of scenario, do you think that potentially could happen here over the next couple of years, or?
Good question. My personal opinion is that it's unlikely. I think what you find is that real estate is unlike other asset classes in that real estate is extremely resilient with its pricing, right? Over the past century, how many times have real estate actually fallen? Once, 2008, really? That's pretty much it. But throughout that 100-year period, there have been interest rates that have gone up, down, very high, even to nearly 20%, and prices still increased during that period, right? So that tells you that interest rates aren't necessarily the deciding factor. There's other market fundamental variables that are playing a role here. And what my belief is ultimately is that right now you have the insufficient supply of real estate to match the demand that exists. So ultimately, supply and demand really drives everything. So in this case, I find it unlikely that prices are going to come down. Like I said, I think it's likely to increase, but maybe slower for a period of time, but eventually it will continue on upwards. Ultimately, even if you want to talk about 2008, that anomaly that existed, it depends on what time period you look at. Ultimately, the nice thing about real estate is if you wait, typically you're going to do okay on the return side, because even 2008, if you bought in 2008, then in 2009, you look like a dummy. In 2009, you still look pretty dumb. By 2012, 2013, 2015, you look like a genius again. So ultimately, what is your timeline? Make sure you enter pretty conservatively. And then if you don't like it, wait a little bit, be patient. And over the long run, it's hard to go wrong with real estate.
Are you finding investors, so in multifamily, bringing on equity partners and third-party investors, it's a lot more common than, say, single family. Are you finding that they're being a little bit more cautious in their approach with new opportunities and expectations?
I think the answer is definitely yes. I think if I had to put a number on this, I would say that we're probably having to work about 5 times as hard to get the same amount of capital. And that said, we're obviously growing with our size deals. We've raised $100 million over the past, roughly 120 days or so. So definitely a lot of money.
Major congrats there. I mean, that's huge.
Thank you. Yeah, hopefully that's the start of a lot more to come. But that said, it is requiring a lot more work on our side. A year ago, there was a lot of money flowing everywhere. Everyone's got more money they know what to do with. So that was a lot easier to have these conversations, but we're having to, 5x that amount now just to get an equal rate in return. But what you find is, realistically, interest rates have been changing. Nobody knows what's to come next. There's a lot of fear, uncertainty, and doubt out there of what's to come next. So people are kind of sitting on the sidelines, sitting on their hands. But realistically, when you look back in time, right, I think history is probably one of the best teachers of what's to come in the future. And you find that ultimately, turbulent times in the market are when the greatest fortunes in history have ever been made. So on our side, we're being conservative with our criteria and our underwriting, make sure that whatever deals we get into, we're buying them right and we're buying them very carefully. But once we find this deal that is great and worth going after, we're making sure to let our investors know that, hey, this is the time where it makes sense, and making sure and explaining it to them, right? It's not just telling them. Of course, there's always going to be some bias in how they perceive us ultimately. But the reality is, our goal is not to push them and say, hey, invest in the deal. The reality is, here is all the information that you need to make a decision. If you want to participate, here's why it makes sense. If you don't, that's totally cool too. We're not here to push you. We're not used car salesmen at the end of the day. But if you're looking to get a really good return on your capital and your investment, then here's why this could make sense for you. And even on the interest rate side of things, right? We're still seeing great rates that we can achieve just because of our track record of relationships and so on. We just got quoted on a deal at 3.5% interest rate. Awesome. You don't see that these days. But This is part of the benefit of what we can provide for people versus what they may be able to get on their own deals or with other folks out there. So there's a lot of uncertainty. But ultimately, they know that if you have a track record of success and you've been diligent in the criteria, and we share everything, we're pretty transparent at the end of the day, where let them do their own due diligence and make sure that what we're telling them aligns with what they expect and how they interpret things. And if all is alignment, everybody is in agreement and makes sense, then we'd be happy to work together and ultimately see what we can get them for a return on the deal.
Love it. Love it. Yeah. It's building relationships and educating.
That's all it is. It's all about adding value and educating for sure.
Love it. Well, thank you very much, Tarek. Appreciated seeing you out at the y'all's event last week. Look forward to coming out to the next one. So thanks again.
Always a great time. Take care, guys. Cheers.
Okay.